We're currently going to be taking a look at the currency market with Shireen Dharmalingham, Macroeconomic Strategist at Standard Bank. Thanks so much, Shireen, for your time this morning. Well, we had quite a bit of weakness filter through to the local unit yesterday. It's weakness that continues to filter through this morning, and we had some saying that it looks to test 2011 lows at 750. Your outlook for the local unit?
Well, yesterday we did see the rand remain on the back foot, and that was basically the rand basically remained at the mercy of global international sentiment. We saw the US retail sales data come in a lot lower than expected, and that really fueled global recessionary fears. We also had the Europeans, we saw the French banks being downgraded by Moody's yesterday, and basically we saw risk aversion being fairly elevated by these two developments. However, this risk aversion moderated somewhat towards the evening when we had the German, French and Greek officials meeting to discuss conditions in that region, and Germany and France indicated, or rather suggested, that Greece would remain part of the Eurozone, and Greece also committed to the austerity measures. So we did see some kind of risk aversion moderating towards the end of the day. And in light of that improvement in risky assets, we could possibly see the rand enjoying some short covering this morning. However, if conditions continue to sour in the US and the Eurozone, we could see the rand test those levels that you mentioned, and an upward move towards 750 is likely.
Of course, looking at those Eurozone issues that persist, we had some comment coming through from the Finance Minister yesterday, supportive to an extent of the local unit, offering some cushion, even though many struggled to see it. We had him say that South Africa was not in the same position as its BRICS partners who can afford to use reserves to buy a debt of Eurozone countries. What did you make of those comments that came through?
Indeed, I think those comments were was pretty much on the mark. The BRIC economies, excluding South Africa, is in a more better position to be able to intervene in that market and to provide that sort of support for the Eurozone. If you consider that China has reserves of about $3.2 trillion, India has about 320, and Brazil about 350. South Africa is in a much worse position with about $51 billion worth of reserves. So it becomes a little bit more of an affordability issue. I think by the end of next week we'll get more clarity on whether they are able to intervene and assist Europe with the debt concerns. But at this point, South Africa seems not to be in the same boat as the BRIC economies.
And further cementing that, some of the comments out of the SARB governor this morning, where we've had Governor Joel Marcus say that, we've got FX intervention policy options somewhat limited, and that with the government budget in a deficit, that problems, of competitiveness cannot be solved by exchange rate alone. Market reaction to that kind of rhetoric that's out there, because certainly what she's come to the markets with this morning, nothing new, nothing that we haven't heard before.
Indeed, nothing that we haven't heard before, and the concern is the fact that local manufacturers are asking for a weaker currency. But if you look at what is happening with the Swiss National Bank and the fact that they peg the currency to, and with the intervention as what Governor Marcus alluded to with the FX intervention, not likely to move the currency much. The Swiss National Bank's peg to the currency is not likely to be sustainable in the longer term, and whether they'll be able to maintain that is questionable. So we're not likely to see any kind of intervention at this point. And as you mentioned before, the competitiveness levels cannot really be affected, or really cannot really be changed by just looking at weakening the currency. So we're not likely to see any major developments on that front.
In terms of data points or factors that you'll have your eye on for the trading day ahead, Shireen, run us through some of it, because we know we've got international data specifically coming through from the US this afternoon, that in the form of CPI numbers, and then the Empire State Manufacturing Index as well. But this in a context where we had yesterday retail sales numbers coming through from the US, and the markets to a large extent ignoring those numbers.
Indeed, they ignored the numbers, I think, on the back of the fact that the Eurozone debt situation is probably of primary concern. But the CPI data and, as you mentioned, the Empire State Manufacturing data are expected to come out today. CPI is expected to come in at 3.6% year on year, and we are expected to see somewhat of an improvement in the Empire State Manufacturing Index. However, it's not really it's still expected to remain within a contractionary phase, the Empire State Manufacturing Index, and it's really attaching to the global trend of what's happening in the manufacturing industry across the world.
Yeah.
We also have the current account data coming out of the US later today, and that's expected to have widened somewhat on the back of concerns that the global economy is not recovering. So the export position on the current account is likely to have suffered somewhat. So pretty bleak data coming out of the US economy later today.